This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
If you thought the trade and tariff outlook was unclear, it got downright opaque this week. Up next, be prepared for a summer of purgatory for the markets as Trump fights the courts and businesses, consumers, and countries for that matter are left wondering what to do. Lots to come and lots to figure out. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Got to admit that these podcasts are getting harder and harder to do in this environment, right? You come in the morning, you just don't know what you're going to get, and the last 7 days has been no exception. I mean, late last week, Trump slaps a 60% tariff on the European Union. 2 days after that, he pauses that until July 9th, and now comes the news this week from the Federal Court of International Trade that many of these tariffs are in fact illegal. Why don't we start there? Because that was kind of the big news of the week. Essentially, the ruling struck down the 10% baseline tariff on all countries, the 20% tariff on imports on China, as well as the 25% tariff on Canadian and Mexican imports that are not in compliance with the USMCA Free Trade Pact. What was left in place were some of the sector tariffs, the 25% levy, for example, on aluminum, steel, auto imports. Those were issued under a different code. So essentially, the court is saying that the Trump administration exceeded their authority in a pretty significant way. So what are we left with here? Well, I guess temporarily, the court ruling lifts a significant tax burden on U.S. consumers and companies. But the main outcome, quite frankly, is uncertainty. I think that's why right after the news, the futures overnight were initially up, at least for the Dow, 600-700 points, something like that. By the time the market opened on Thursday, they were essentially flat. And it's because the outcome is uncertainty. For one, the decision's going to be appealed. We know that. We know that Trump's going to appeal it, maybe all the way to the Supreme Court. Two, he may use other legislation. There are other codes that he can call upon, if you will, to reimpose those taxes. Certainly, existing trade negotiations, we just had some sort of deal with the UK. Presumably other negotiations are underway. They have to be questioned. I mean, let's be honest. Why talk seriously if the U.S. stance is unclear? I don't think it's a coincidence or an accident that a lot of the other countries that we're supposedly talking to, Japan, Vietnam, and the like, were kind of slow rolling this thing, right? Maybe they anticipated this ruling. One significant outcome of this is that Trump's hand has been weakened. So even if he's able to get something through somehow on appeal or by circumventing this ruling, his hand has been weakened. And we all know that who wrote the art of the deal, right? So that's not a good thing for Trump. But really, maybe most importantly for us as investors, why would companies invest or even hire in the United States when taxes on their supply chains and on their customers' spending power remains unclear? So, not to mention, right, that we have a tax bill that's trying to work its way through now the Senate that relies on some of this tariff revenue. Okay, so I got to tell you, I think it becomes a little bit harder to support a political argument for a fiscally expansive tax bill. So we'll see what happens. I'm not going to get into all the legal ramifications of this. Like I said, I think this is going to drag on for a couple of months, at least, maybe more, particularly if it has to go all the way to the Supreme Court. And there's going to be a lot of back and forth in the meantime. But again, I think for us as investors, uncertainty is the big thing. And guess what happens when you have uncertainty? People delay decisions. So in many ways, regardless of how this thing plays out, not only is the damage been done to an extent economically for us as consumers and businesses and investors, but that damage is going to continue to be done over the next couple of months. Remember, I've been talking a lot over the past number of podcasts, I think Chase Hinderstein has as well, about the big gap between the the quote-unquote soft data and the hard data. In other words, the sentiment data, what that kind of reflects how people are feeling, has looked a lot different than the actual data, what people are actually doing, like retail sales, employment, okay? And specifically, the hard data has been resilient. The soft data has been deteriorating at a pretty quick rate. So, for example, I was looking at what's been called the misery index, which was created in the 1960s by an economist, which essentially adds the seasonally adjusted unemployment rate to the annual inflation rate. Well, if you look at the soft data, the misery index has spiked dramatically. But if you look at the hard data, it's actually been coming down. Less misery, mainly because inflation's been coming down in the short term. The conclusion here, and I could point to a lot of other examples, I'm not going to get too far in the weeds on this, but the conclusion is that historically, generally the soft data will eventually catch up, or catch down, I should say, to the hard data, meaning whatever the soft data is saying, eventually that sort of predicts, if you will, or is a harbinger for where the hard data ends up. But I have to tell you, in the meantime, things have been, really mixed. So we got a little bit of a bump in the soft data, presumably as trade tensions with China dissipated a bit. And there's a lot of evidence that the American consumer has been hanging in there. So, for example, Memorial Day box office spending, movie box office, sets a new record. That's consistent with other activity metrics too, like restaurant bookings, credit card spending, TSA, travel data. American consumer is still out there. But I think what's a little more concerning is what we saw early this week is that there's definitely some cracks in the business spending picture. Specifically, the Census Bureau data this week for so-called non-defense capital goods, excluding aircraft, which is really essentially corporate CapEx, corporate capital expenditures, business investment. It's a really important set of data because it's generally been considered a leading economic indicator. It reflects a company's confidence in future activity. And yes, the data can be noisy on a month-to-month basis, but the reality is it fell 1.3% month over month, which was pretty significant and below consensus expectations. So, just kind of thinking this through, it could be that businesses are sitting on their wallets, and since they're the ones to deal with tariffs, I guess be the first line of having to deal with tariffs, right? Through their supply chains and their import costs. They're sitting on their wallets. And it hasn't yet flowed through to customers, either because there is a delay from companies receiving goods to it actually being distributed out, especially since there's a lot of stuff sitting in warehouses. A lot of companies bought and stockpiled ahead of tariffs, right? So there is a delay before it feeds through to consumer prices. Also, let's face it, some companies are going to be reluctant to raise prices. They're going to try to see if they can cut costs and do things to mitigate those expenses before they pass them along. But the reality is the hard data has been resilient on the consumer side, less resilient on the business side. My expectation is those things will reconcile over the course of the next couple of months, and probably not in a positive way. So I'm not sitting here telling you that we're going to go into recession. I'm hoping we can avoid some of the worst case scenarios. But to think that we're going to skate by without a material drop in economic activity, I think is probably naive. And really what happened over the past week with this wrench, if you will, into the tariff negotiation process, I think only delays that. Because again, what company in their right mind is going to make serious capital spending decisions, including hiring decisions, with this degree of uncertainty? We'll see. Meanwhile, if you look at kind of the market behavior, I think there's some positives, right? Not only has the market rebounded significantly, we talked about that a couple weeks ago. The move over the last 30 days has really been one for the ages. One for the ages. I think it's top 12 or 13 now, biggest 30-day recoveries off a low, going all the way back to 1950. Meanwhile, I thought it was interesting. I looked at some of the consumer sentiment data. For the first time in 15 weeks, the American Association of Independent Investor Sentiment Survey reflected more bulls than bears, more people positive than negative. Again, first time in 15 weeks. And Ryan Dietrich, he's a trader that I follow, noted that when we have those types of multi-week streaks, it's generally bullish. He went back to 1990. The S&P 500 is up a median of 22% a year later, and at least double digits 7 out of 8 times when you had at least a 15-week streak of people more negative than positive. In other words, it's the ultimate contrarian indicator. When you have such extended period of negativity, generally results in better markets 12 months out. The only time that did not work was 2008, according to Dietrich, which of course was the financial crisis year. So the hope is, and again, it's a hope, not a prediction, but the hope is that we can avoid a significant economic downturn, that maybe things can look a lot better a year from now than they do today. I think even though the bull-bear data got a little more bullish, I will say overall, other types of data and readings support the idea that the American investor is still cautious, and a lot of that is asset flows. So that the guys over at Strategas, Ryan Grabinski, he noted this week that at the start of the year, stock exchange-traded funds were averaging about $3 billion in inflows a day. Whereas since the April 8th market low through, I guess this is Wednesday of this week, the daily average is down to $1.4 billion. So the flow data has shifted from high expectations to a much more skeptical position. And I would also tell you that you've seen a significant drop-off in exchange-traded fund inflows into more economically sensitive areas, like levered long funds, small caps, cyclicals. So that's also reflective of a cautious investor, an investor that's not that excited about growth potential. So that's supportive. Again, when everyone's bullish, when everyone's fat and happy, that's when you have to be concerned. The fact that we've had a pretty significant market rally, yet a lot of people haven't bought into it, people are still cautious, skeptical, I think that's a good thing. Okay, so keep that in mind. By the way, a lot of people have, going back to President Trump and tariffs, just for one more minute, a lot of people talked about how eventually he might slow down with some of his aggressive, positioning, whether that being trying to launch a trade war or being very forceful in trade negotiations. But if you look at it, since Inauguration Day, and I was just, kind of doing the math this week, stock prices are basically flat, bond yields are down, employment pretty steady at a robust level. Inflation's actually down since Inauguration Day. Credit spreads, between corporate bonds and treasuries, pretty tight. None of those things are suggestive of a panicking market or a market, quite frankly, that is uncomfortable with what Trump is doing. And I know that sounds kind of weird to say because obviously there's a large percentage of the population that is uncomfortable with what Trump is doing. But if you actually look at the markets themselves, we haven't seen as much chaos, stress as maybe the political headlines or at least or even the sentiment figures would indicate. The only reason I mention this, I'm not supporting Trump or not supporting Trump. I'm just saying that if I'm President Trump, I might say, well, everything I've done so far hasn't led to a lot of market chaos. And maybe that's because the markets are looking past this to thinking that things will get resolved in a more favorable market and business-friendly way. Maybe that's true, but Trump might be thinking, well, I'm going to keep going because it hasn't caused a lot of chaos. So I just say that because if you're sitting there thinking, you know what, I think things will get less volatile, maybe things will calm down later this year, I wouldn't bet on it. Wouldn't bet on that. I think we have to expect a continued volatile environment. So with that in mind, I thought I'd switch gears just for a second and make sure we don't misbehave in a volatile market. The guys up at Ritzold Asset Management, guys and gals, I should say, they wrote a really good piece the other day talking about some of the biases that many of us have. And I think when you go into or live through a volatile environment like this, sometimes it's good to step back and look in the mirror, and I do this as well. I have my own portfolio, right? Sit back, look in the mirror, and make sure that you're not being guilty of some of these things. Because I've said for years, and I will continue to say it, the biggest enemy of a successful investing outcome is not interest rates or Trump or tariffs or bad earnings. I mean, yeah, those things can affect you on a day-to-day basis, but over a long period of time, those are not your enemies. Your enemies are yourself and controlling your emotions and making bad decisions, emotionally based decisions. So I thought I'm not going to go through everything that Ritzold said, but I'll just highlight a few of the biases that I've talked about before. Again, this is a self-reflection moment. How about loss aversion, right? This is the most important concept in finance, that it's well understood that losses hurt twice as bad as gains make you feel good, right? Well, I bring this up because, the more often you look at the market or your portfolio in a down market, I know things have rebounded recently, but go back to April. The more often you look at the market or the portfolio, the worse you're going to feel. And that's always true to an extent, but it's amplified during volatile markets. And I think what happens also is people lose their perspective, right? So even at the bottom, the April 8th bottom, right? If you had a diversified portfolio, when I say diversified, you had some stocks, you had some bonds, you had some cash. Let's say, I'm just throwing out a number. This is not a market performance comment, just throwing out a random number. Let's say you were down 8-9%. No one's going to be happy with that. But if you keep it in perspective, if you had that same portfolio in 2023 and 2024, you may have had double-digit returns those 2 years. So even at the bottom in April, you might have only been given up, 20-25% of your 2-year performance. People lose that type of perspective. And I think what happens is also, people kind of take the gains and the up markets for granted and assume that the losses are the exception. But both are givens. As the late Rick Malone used to say, those are the fleas that come with the dog. We know, and I've said this on this podcast 100 times or more, that 5, 10, 20% pullbacks are the norm. We've averaged a double-digit intra-year pullback almost every 12 months going back to 1950. That's a fact. It's funny, sometimes a client will come in for a review and he or she might have 25 or 30 stock holdings and we're going through them. And inevitably, most of the conversation will be about, the ones that have lost money, the ones that aren't performing. Even if 75%, again, I'm just throwing out a number, even if 75% of the portfolio is either positive since inception or even positive in the near term, we tend to focus on the losses. Check that feeling at the door. How about anchoring? A well-known psychological issue. It's when a default starting point influences your decisions. What do we often do? We anchor either, if you're talking about an individual stock, right? We'll often anchor to a stock's cost basis, what we paid for it, or what the all-time highs on those stocks are. Okay, so let's say, I bought a stock at 100 and it goes up to 200 and then it's back down to 150. Well, it's still a 50% gain, right? But we think about the 200. We think about the fact that it's down from 200, and that's what we anchor to, as if we have some God-given right to the absolute all-time high print on an asset or a security. We do this with our houses all the time, right? People think about, what was the most that your house was ever worth, and if you go to sell your home, you're very reluctant to take less than that all-time high price, even if the current market conditions suggest it should be worth something different. Remember, an asset price of any type, doesn't matter what it is, a house, a stock, a bond, they will reflect current market conditions. So anchoring to something that happened 6 months ago when the circumstances, conditions, the sentiment was different, it's a natural thing to do, but it doesn't make any sense. And I bring this up because people will make poor decisions as a result. Like, I'll just sell when I break even on my investment. I can't buy that stock now. Look at where it was trading, 3 weeks ago at the depth of the correction. Sure, the market's down 15%, but I'm not going to buy till it's down 30%. You can't anchor to artificial targets. They don't make sense. You've got to deal with the present reality. Now, as a result, sort of similar to that is the sunk cost fallacy. When your decisions are determined by investments that have already been made. I think the best way to, in other words, I can't sell these stocks now because I paid more for them in the past. Same idea as anchoring, but I think a really helpful way to look at this is if you were starting from scratch today and your entire portfolio was all cash, would you still hold the same mix of assets? We do this analysis all the time. Like if we have a stock in the portfolio that, let's say, it hasn't done well, okay? We say, well, listen, if we were just coming in today, would we still buy the stock? Would we buy it at this price? If the answer is yes, it's a hold. If it's not, we have to think long and hard about whether we want to hold it, regardless of what we paid for it. Nobody likes to take losses, but if the answer is no, I wouldn't buy it today, then you got to get rid of it and put it in something else. The last one I'll just mention, I don't want to spend too much time on this, but is hindsight bias, right? I mean, we're seeing a lot of that right now, right? The assumption that the past was easier to foresee than it actually was, right? I knew that Trump was going to slap tariffs on everybody, right? It was obvious. He told us that during the campaign. That's why I got out of the market. Now we have the rebound. I knew this was all a negotiating tactic. I knew he didn't really, mean all that. I've heard both. I've heard both over the course of the last few weeks. The reality is you have to manage money in real time, okay? If it were that easy, the markets wouldn't be this volatile, right? Why do you think the market moved down so much after Liberation Day? Because the news was much different than what the expectations were. And the biggest market moves come when things are unpredictable, when you can't necessarily see something coming. That's the whole reason the markets react that violently. If it was something that everyone expected and that's what we got, markets don't move very much. So don't get caught up in that. So again, I don't want to spend a whole lot of time on this part of it, but I just think it's a good time for self-reflection when, especially when you've had this kind of V-shaped move, to look back and say, what are some of the things I could have done differently? I think in many cases, if you just stay patient, if you let the markets kind of work its way out, many cases you're going to be just fine. We certainly made some moves ourselves. We did some buys, we did some sells, but we kept the core of our portfolios intact. We did not make any dramatic changes to clients' asset allocations, and for the most part, I'm generalizing. We didn't go to cash or anything like that. I think if you can avoid those sweeping moves, most of the time it's going to work out. All right. Up next, stick with me. I want to transition a little bit to the specific. Heard a lot of news flow from some of the Magnificent Seven names over the course of the last couple weeks that I think are very much worth sharing. Back in a minute. Higher inflation and higher interest rates could be coming, but bonds are still beating stocks so far this year. How should we think about positioning for stability and cash flow in a more volatile world? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
So we got the earnings this week from NVIDIA. I think you all know who NVIDIA is, symbol NVDA. In many of our portfolios, we did pick up some shares a few weeks ago in April, and they just reported their quarter. Remember, just as a reminder, NVIDIA is a name that we do own for a lot of clients. It's also a name that I own personally, so you can consider that a conflict of interest. And if we did buy it for you and you're a client, you can assume we did our due diligence and we think it's suitable for you. If you're not a client, you really need to do your own homework. Make sure that it works for you, that it's a suitable investment for you, because I can't manage your portfolio through the computer. But NVIDIA, as mentioned, came out with their quarterly results. Market responded pretty well to the numbers, I think, for the most part, because as the Raymond James analyst noted, their China business has really been compromised, right? I mean, due to trade restrictions, mainly from the United States in terms of delivering into China, they have as much as an $8 billion hit to their yearly revenues, right? So that's a big deal. But I think what NVIDIA was able to kind of prove through their quarterly results is they have significant growth outside of that. And I would say that the China business has been somewhat de-risked. And when I say de-risk, what I mean is it's so telegraphed, management has been so transparent about it, that I think a lot of that risk is already baked into the stock price. But if you look at the rest of their business, I mean, their earnings were up 69% year over year. All right, their data center revenue jumped 73% from this quarter over the same quarter last year. And the CEO, Jensen Huang, he was very bullish about the future of AI. I'll just read you a quote. Countries around the world are recognizing AI as essential infrastructure, just like electricity and the internet. Pretty powerful quote. In particular, he spoke to an emerging Middle East business that, quite frankly, didn't exist a year ago. We know there was a big data center announcement from President Trump recently there. That's going to be a big potential market for NVIDIA. Their cash pile has accumulated. They're up to about $53.7 billion in cash. That's up 25% year over year. So their balance sheet strength is the strongest it's been. So there's a lot to like there, and really no signs of slowing there for NVIDIA. In fact, the CEO noted that, quote, we have a line of sight to projects requiring tens of gigawatts of AI infrastructure in the not-too-distant future. Keep in mind, each gigawatt, according to Raymond James, is potentially a $50 billion opportunity. They mentioned tens of those. So I don't know if they're going to get all that business, but NVIDIA is showing no signs that they've lost any market share, no signs that there's any lack or slippage in demand for what they're doing. Obviously the risk factor, they are certainly to some degree at the epicenter of this trade war, not only in terms of wanting to do business in China, and they've said that they're looking for ways to do business in China despite some of the restrictions, but President Trump has talked about tech-specific tariffs, so we'll see what happens there. And of course, it's still a competitive landscape, not only with other countries, but with other companies. And certainly there's the idea that the return on investment of AI has been questioned a bit. At what point does the buildup become profitable for companies using AI? We'll see. But in the meantime, there's been no slippage there. Their valuation, certainly not a cheap stock by any stretch, but not unreasonable. They're trading roughly 32 times 26 numbers at this point. Their 5-year range, according to Raymond James, 20 to 67 times. So they're half as expensive as they were late last year. Seems to me that that's not an unreasonable multiple. It's not a cheap multiple, but it's not unreasonable given the company's generation AI dominance, new product cycles coming, and what have you. So NVIDIA, I don't know that it's a buy here, given the strong move off the bottom, but it's certainly become a core name in the tech space and one that I find interesting. Speaking of tech, there's been a lot of talk about Apple. We'll see what happens in the short term with this court ruling basically throwing out or at least declaring illegal some of these China tariffs. But, President Trump last week reiterated that Apple is going to be facing 25% tariffs on all imports, or 20%, I should just say 25% tariffs in general. I think the hope was for Apple that, like in the first administration, that they may be able to carve out some exceptions, if you will, with the Trump administration, that some of their products and supply chains will be exempt from tariffs. Looks a lot less likely now with some of the rhetoric over the past week. In fact, the CEO, Tim Cook, apparently visited the White House. I don't think that went well. That's why Trump came out with that. Just to give you a little history, in Trump's first term, obviously there was a lot of rhetoric about, competing with China and concerns about China. So what did Apple do? They started to route their production away from China, at that time mostly to Vietnam, but then more recently to India as a way to kind of get around that. And that was heralded by the Trump administration. Well, in the current tariff environment where Trump wants to put tariffs on every country essentially, Apple is kind of left with no place to go. And the recent call from President Trump is that they need to bring all the manufacturing back to the United States. Well, the reality is nobody thinks that that's even remotely feasible. In fact, multiple analysts, I was reading a report from JP Morgan. The JP Morgan analysts called that pure, fantasy. Because even, if they were to bring things back, for one thing, it would take them, by JP Morgan's count, almost 3 years just to move 10% of their manufacturing. It would also cost them about $30 billion to do that. Just on the face of it, JP Morgan estimates that it would increase iPhone prices by as much as 30 to 40%. Just in terms of labor costs, manufacturing costs. A lot of the products are made, through robotics, automation, and just training, building that infrastructure, training that infrastructure. And by the way, it would not necessarily add a ton of jobs either, if a lot of it's going to be robotics. So it's just what Trump wants from Apple is not feasible. That's sort of the problem. So Apple's left in a sort of a tough position. I will say there is no methodology to put tariffs on a specific country. So pretty much all the cell phone manufacturers would have the same tariffs, Samsung and the like. So from a competitive standpoint, I don't think Apple would lose market share because everyone's going to face the same, cost issues, but it certainly could bite their margins. So we'll see what Apple does with that. Certainly they have the ability to navigate higher tariffs because they have such high profit margins. It could be that Apple just decides to kind of wait this thing out. We saw what happened this week with the tariffs being declared illegal, essentially. So maybe Apple just kind of waits. But I do know this. I don't think any major company, including Apple, is going to make major capital moves, building plants that cost billions of dollars without having a better feel for what the resolution is going to be. Because, you start that process and 3 months from now the tariffs don't exist, you just wasted a lot of money. So I bet you we're not going to hear much from Apple in the short term. I will also say that, remember, their service business has been phenomenal. So even if people are not upgrading their phones, or if phones get more expensive, chances are they're going to hang on to their existing phones, and they're still going to be paying for the services, right? The App Store, the music, of course, Apple Pay, all the various things. So that's going to be a pretty consistent business for Apple. I think Apple's real issue, and one of the reasons why Apple stock is down 17, 18% this year, they've been the worst performing Magnificent 7 stock. They need to get their AI capabilities straightened out. Remember that their Siri, their sort of how you can ask questions to Siri, that was supposed to have AI capability this year. That's gotten pushed back to 2026. So quite frankly, there's not a lot of incentive for people to upgrade their phones. In fact, the average age, according to JP Morgan, of a phone has lengthened significantly here in the United States to about 2.5 years. It's even longer than that overseas. So people are just hanging on to their iPhone 13s or 14s or 15s rather than upgrading. I think the only way that really changes is if you have a significant technological advance, namely AI. So that's probably the bigger story than tariffs for Apple. Okay, so I think Apple's in a bit of a purgatory at this point, would be my guess. I think there's a reason why it's the worst performing stock, but if you consider their infrastructure, their installed base, and the interconnectivity of their base. In other words, people who have iPhones generally buy iPads and the AirPods and everything else, the iWatches. I mean, that infrastructure seems to be very much intact. So just keep that in mind. I think with Apple, if you are a long-term holder, and we certainly have clients who are long-term holders of Apple, you just have to be patient and hope that the technological side of Apple advances. The other one I just wanted to mention briefly is Google, of course now known as Alphabet. They've been under a lot of fire recently. When I say recently, really for a number of months, because their traditional search business, it's become a verb, right, to Google something. Their traditional search business has been called into question. In other words, will AI essentially replace search on the internet? That has been a major reason why Google is the cheapest of the Magnificent Seven stocks. In fact, they're trading at a discount to the S&P 500. But they had a sort of a developer conference recently that was very well received. And companies like Goldman Sachs, for example, came away very positive. And I won't get into all the details on sort of the new product lines, but there's been a lot of innovation afoot at Google that suggests that AI searches are not replacing traditional web searches, Google searches. They are accretive. They are additive. They are supporting Google searches. So that was the takeaway. And the second takeaway is that companies like Goldman have a lot more confidence that Google can actually monetize that. In other words, that the ad spending, which is the majority of Google's revenues, is sort of transferable, for lack of a better word, to an AI architecture from a traditional search architecture. So, in other words, it's one thing to have people continuing to use Google. It's another thing to have companies actually pay to have advertisements, on the things that people are looking at, right? Goldman Sachs seems to think, and many others coming out of that conference, that is going to be the case. And Google stock has responded favorably over the course of the last few weeks. So, the risk, of course, is just the continued competitive environment and how successful that Google will be in sort of making that transition to the new technology. I do think the valuation does give them support in doing that. They're not at 30 or 35 or 40 times earnings. They're at less than 20 times earnings. And I think Google is a reasonable name to consider if you want maybe quite frankly, the cheapest way to participate in that at sort of the large cap major company level. So there's other stuff going on as well, but I thought bringing up to speed on Google, NVIDIA, and Apple made some sense. As I always say, in this environment, there are probably more questions than answers, but those are three that I find interesting here. Hope that was helpful. As always, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.